Picture this. Tuesday night, rent's gone out, groceries are done, the power bill's paid, and there's $400 sitting in your account until payday. You look at that number and think, how am I supposed to invest anything when I can barely keep my head above water? Meanwhile, everyone online is flexing about investment properties, mates talking about their share portfolios, some influencer telling you if you're not throwing in 10 grand a month, you're basically behind. So you close the app. You tell yourself, I'll start when I've got more spare cash. Maybe next year. Maybe when rates drop. Maybe when the kids are older. Here's the problem. That belief, the one that says you need thousands sitting around before you can start investing, that's the exact thing keeping most Aussies broke at 65 and stuck relying purely on the age pension. Because you don't need 10 grand. You don't even need $1,000. You need about $100 a month and about 15 minutes to set it up properly. Stick around, because by the end of this you're going to have an actual roadmap, not some vague just invest advice. A real step-by-step plan you can start this week, even on an average wage, even with the cost of living eating you alive. And if you click away now, in 10 years, you'll be having this exact same conversation with yourself, just 10 years older, with nothing to show for it. Let's talk about Dave. Dave's 34, works full-time in Logan, just outside Brisbane. Decent wage, nothing flashy. Rent's gone up $200 in the last year alone. Servo prices make him wince every time he fills up. Dave's not lazy with money, he's just stretched. By the time bills are sorted, there's maybe $200-300 left floating around most fortnights. And every time he thinks about investing, his brain goes straight to guys with six-figure share portfolios, property investors with 3 houses, finance bros talking about diversifying into international equities like it's a normal Tuesday conversation. So Dave does what most of us do, nothing. He figures he's too far behind to bother. He figures $100 here or there won't make a dent anyway. So what's the point? Sound familiar? If you're nodding along right now, I get it. Cost of living isn't some abstract headline, it's real, it's showing up in your grocery bill, your rent increase, your petrol tank. Nobody's out here judging you for not having spare cash lying around. But here's what Dave didn't realize, and what most people never get taught. Investing was never about having a huge pile of cash sitting there. It was never about picking the perfect stock or timing the market like some Wall Street trader. It's about one boring habit, done consistently, for a long time, and that habit costs about as much as a few coffees a week. Point 1. The barrier was never the size of your bank account. Here's the wrong way most people think about this. They wait. They tell themselves, once I've got 5 grand spare, once the mortgage is paid down a bit more, once I get that promotion, then I'll start investing properly. Here's the right way. You start now, with whatever you've got, even if that's $100 a month. Because money invested today has decades to grow. Money you're planning to invest in 5 years' time has 5 less years of growth. That gap, that's the real cost of waiting, way more than the size of your first contribution. Say you put $100 a month into a low-cost, diversified index fund. Nothing fancy, no stock picking, just a fund that owns a slice of hundreds of companies at once. Historically, over long stretches, Australian and global share markets have averaged somewhere around 7 to 9% a year, though that's not guaranteed, and it moves around a lot year to year. Keep that up for 20 years, and that steady $100 a month, sitting there quietly compounding, can turn into something like $60,000-70,000. Not because you got lucky, not because you picked a winning stock, just because you started and you didn't stop. But here's the catch. This only works if you actually get the money moving automatically. Which brings us to the part everyone gets stuck on. Point 2. Building the actual pipeline. Before a single dollar goes anywhere near shares, sort out a tiny buffer first. Doesn't need to be huge, even 500 to 1,000 bucks sitting in a separate savings account. So an unexpected car repair or vet bill doesn't force you to sell your investments at the worst possible time. Once that's sitting there, open a low-fee brokerage or micro-investing account. There's a handful of solid Aussie options built exactly for this. Low minimums, low fees, and they let you set up an automatic transfer. So the investing happens whether you remember or not. Set that transfer for the day after payday. 100 bucks straight into a broad, low-cost index fund, something that spreads your money across hundreds of companies both here on the ASX and overseas, rather than betting everything on one or two stocks. Then, here's the part that separates the people who actually build wealth from the people who just talk about it. You turn on auto invest and you leave it alone. Now, quick word on your super, because this matters too. Your employer's already tipping in 12% of your wage without you lifting a finger. That's the current super guarantee rate. If your budget ever allows a small extra voluntary contribution through salary sacrifice, that's another automatic wealth building lever, and it comes with tax advantages most people never bother looking into. It won't touch your day-to-day cash flow the same way your $100 investment does, since you can't access it till retirement, but it's quietly working away in the background too. 2 automatic systems. 1 outside super for accessible wealth, 1 inside super for retirement. Both running without you having to think about it every week. Point 3, and this is the one that actually determines whether any of this works. The wrong way is checking your portfolio every single day. Panicking when the market dips, pulling your money out the second the news gets scary, then jumping back in once everyone's saying it's safe again, which is usually right after the best gains have already happened. The right way is treating this like a gym membership for your money. You don't check the scales every hour, you just keep showing up. Markets go up, markets go down, that's not a malfunction, that's just how it's always worked. The people who actually end up ahead aren't the ones who timed it perfectly. They're the ones who kept that automatic 100 bucks flowing in through the crashes, the corrections, the scary headlines, all of it. Consistency beats timing. Every single time. Now picture Dave again, except 15 years down the track. He never got a pay rise that changed his life. Never won the lotto. Never picked some hot stock that shot through the roof overnight. He just kept that automatic 100 bucks a month running through the good years and the rough ones, and let it quietly do its thing in the background while he got on with his life. 15 years later, that unglamorous habit has turned into a chunk of money most of his mates, the ones still waiting for the right time to start, don't have. Not because Dave was smarter, not because Dave earned more, because Dave started when everyone else was still waiting for permission. That's the whole secret. There isn't some hidden trick the wealthy are keeping from you. It's 100 bucks, an automatic transfer, and enough patience to leave it alone. Setting up that automatic transfer is step 1, and if you followed along this far, you already know more than most Aussies your age. But here's where people usually trip up. They open the account, they see a wall of fund names and ticker codes, and they freeze, because nobody tells you which one actually makes sense for your situation, or which ones are quietly eating your returns with hidden fees. That's exactly the mess we untangle in the next video, where we break down how to actually pick the right fund without needing a finance degree to understand what you're looking at. Dave figured it out. So can you. Click the video on your screen, and let's sort it out properly.